Hey everybody. So as you've probably noticed, the market has been terrible. Basically, all the gains that we all got since effectively August or September have been completely demolished. Tech companies have had a major correction. Heaven forbid you were invested in Tesla, but honestly, why would you do that in the first place? So I just wanted to walk through 5 things that I've been doing to take advantage of this moment. Wealthy people in our economy love when the market goes down. They love it. The reason why is because you have assets that are incredibly valuable that are now underpriced. You can basically get a 20, 30% discount on something that is fundamentally the same company. So, how can you, the everyday person, also take advantage of that strategy to maximize your dollar? This is all about working smarter, not harder. And what I want you all to start thinking about is you don't have to literally put in more effort. You don't necessarily have to put in more money, but you do need to be smart and strategic when you decide to invest and how you decide to invest. So these are the 5 things that I'm doing in my portfolio. This is not financial advice. Go talk to your financial advisor, but this is what I'm doing. All right, so let's get into it. Number 1, I have increased my 401k allocation. Why? Because my 401k allocation, if you work at a company, you have a 401k and you have matching, your matching is up to 3% of your salary. And there's a max amount. I believe it's 23,000 something. I think it changes. I think it changed again, of course, this year. But that's the max you could allocate or invest all year. So for me, I can decide, okay, let me front load that actually in Q1, Q2 this year so that I'm maxing out earlier when I know that the stock prices are down. So let me say that differently. If I'm investing $20,000 this year at my 401k, then I'm also gonna spend that 20,000 regardless, right? Like that's a sunk amount of money that I'm already saying I'm putting in $20,000 into the market via my 401k this year. But if the stocks are down, then that $20,000 might actually really be more like $25,000 that I'm putting into the market in terms of value because I'm getting the stocks while they're at a discount. So it's the same amount of money, but I'm getting it at a better price, which allows me to have an outsized outcome just because I'm front loading my investment when stocks are down. The other beautiful thing about stocks right now and investing, and this is something called dollar cost averaging. So when you're dollar cost averaging, you're putting the same amount of money in over a period of time, which is what happens in your 401k, right? In your 401k, you're investing it every paycheck. You're buying a set of shares every paycheck, right? So I'm getting the best price every time I invest. So if the stock is high and I'm putting in $1,000, then I'm getting that price. But if the stock is low and I'm putting in the same $1,000, now I have more shares for that exact same price. So dollar cost averaging is basically how you manage your risk, and you don't have to overthink it. Fundamentally, the value of those companies has not changed. Microsoft, Amazon, Costco, Palo Alto Network, Verizon, they have not changed. Okay. 3 months has not changed how much we are all using Amazon or how good Audible is or how big One Medical is, right? So it's on a discount. If the company is good and the company has good fundamentals, the value of it has not changed. It probably was just overpriced before, frankly. I had a couple of stocks that I was investing in that were good companies, but they were growth stocks. A company that I was invested in is called Hims and Hers. They're basically telemedicine. They mail you a monthly subscription of like semaglutide or things to grow your hair, or I think they even have a birth control or all types of stuff. And it's been a company that's been around for a while. They've started as a startup. I've been tracking them since they were a startup. They then IPO'd, and they've done pretty well. But they're in a highly regulated industry right now because semaglutide, which is the compounded version of Ozempic, Wegovy, etc., is now under a lot of regulatory changes on if they're going to be allowed to have semaglutide or not, and it keeps changing. So I have taken my money out of that stock because it is unclear what's going to happen, and I have moved that cash that was invested in him and hers and rebalance my portfolio into, frankly, boring stocks. Microsoft, Verizon. Verizon I love because it has a juicy dividend. So even if it goes down slightly, your girls give me a dividend and I reinvest my dividends. So over time, the value of my asset is continuing to grow from just one investment. So in essence, look at your stock portfolio and then decide where you want to reallocate your portfolio to things that might be more stable in this type of market, things that are a little bit less high growth and experimental, because they're going to be the ones that aren't going to be able to withstand the ups and downs of interest rate changes and tariffs and all these different regulatory changes. But a fundamentally good company is a fundamentally good company. And that is true at any point in the market's history. So make sure you are rebalancing, reallocating. I even took some losses. Like there was a couple of stocks that I invested in last fall that the market was going up, and who knew the market could have kept going, which it did, but now it's actually at lower than the stock price than what I bought it at. Again, it was like or late fall. So I got two options. I could leave that, let's call it 10K in this stock, where basically I still have the exact same 10K. It had gone up. It was at, I think like up 30%, and now it's back down to the same price. I could leave it there, but it's in a stock that is stable, but not necessarily the most stable company. Or I could rebalance my portfolio, take that stock and move it into something like a Verizon, a Microsoft, something that's more stable that also has a dividend, which is exactly what I did. So that's something to consider, is like, even if you have a stock or a company, if you're doing individual stock trading that is in a good company, you might want to just move it into something that's even safer. And it's okay if you didn't take those gains in December and January. Like, timing the market is very difficult. Most people can't do it. So don't be hard on yourself if you feel like you lost value just because the stock market is back at the same price at which you bought your stocks, or maybe even a little bit lower if you came in when it was high. That is totally fine. But just know that you don't look at and evaluate yourself on past. Look at your portfolio and evaluate it based off of today, not the past. Because a lot of people get caught up thinking about, oh, I could have made 10, I could have made 20, I could have made, it don't matter. It's done. It's done. The time has passed. So deal with the reality of your situation today and then make decisions from there. Now, in terms of cash, one thing I did do in January and December was I just held a lot of cash, because I was like, stock market looks high. Donald Trump is doing way too much. It's giving unstable. So good news is that value of that dollar is now up 30%, baby. Okay. So your girl's going shopping. Like I said, dollar cost averaging, but I'm also keeping my money in a high yield savings account. So make sure that if you are sitting on cash, if you are waiting, that you're not just putting it into a regular bank account or even just keeping it in your brokerage account. I've made that mistake before where it's like, okay, you're just waiting to get back in, but it's in your brokerage account, which means you're not necessarily getting a high yield on that cash that's in your brokerage account. If you have lump sums waiting to go in the market, that money is sitting in a high yield savings account, and that, you've basically set it up so that the accounts are connected. So when you want to move money over, maybe it's a 1 day, 2 day delay, depending on, how your banks communicate with each other, but like, you're still getting the high interest from keeping your cash in a good place. Now, high interest and high yield savings accounts, the interest rates are constantly changing. When it was all in vogue the last couple of years, I think it was like 4.5%. Obviously, interest rates have gone down, but it's still better than nothing. Okay, so make sure that you're taking advantage, putting your money work for you so you can work smarter, not harder. All these frameworks and tools that I talk about on this channel, on this show, are about how you can get more with the exact same effort. You don't have to try to do too much. You don't necessarily have to work more hours in a day, but you can be smarter with how you're spending your money and how you're spending your time, and making sure that you know the basics. And if you don't want to do any of this individual stock trading because it feels overwhelming for you, that's totally fine. Look into index funds, look into mutual funds. You can invest in the S&P 500. There's so many different ways to diversify your assets outside of individual stocks. And you can do simple research to get those answers or sign up for a financial advisor at your local branch of Fidelity. There's a lot of different resources out there. The most important thing is to take action in this moment because it's an opportunity to buy and get in the market when it's low. All right, so let me know what you think. Put some thoughts in the comments. Make sure you're subscribing to the channel, and thanks for always being here and tuning in. Until next time, bye.